Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today is Thursday. It's June 8th. It's about 8:08 in the morning. Believe it or not, but I actually overslept today. I did. I overslept. I woke up at 7:20 instead of 7 a.m. Shame on me. Anyhow, welcome. Folks, for anybody who's new here, who doesn't know me, my name is Roger Scott. I'm the Senior Strategist for Wealth Press. And if you're watching this video, please like our channel on YouTube. Go to the YouTube Wealth Press channel, like our channel, subscribe, and post comments and feedback. I respond to every question that you post in the YouTube channel. If it's not private enough for you, send me an email, support@marketgeeks.com. I want to know if I'm helping you navigate this market or if it's not. Let me know. I want to be there, and give me some suggestions and tips to make these videos better. Now let's get into today's analysis. The market, as you can see here, pre-opening is pretty flat. This is randomness, 33,690, down 13 points, down 8. A lot of randomness. Now, I hate to say I told you so, but I warned you that the Nasdaq 100, this is the equal weighted Nasdaq 100, and you could see it's after 3 days of staying out of range, it's finally moving back into the channel. Overbought levels or momentum levels are just now getting into the even territory, but I'm expecting this to continue moving this way. Now, if you look at the non-equal, the capitalized weighted Nasdaq, it looks totally different. I mean, look at these two graphs versus this. That's all FANG stocks and algos, and I'll talk about that tomorrow as well. But I'm expecting a much bigger decline here because I believe stocks like Apple, for example, let me show you. Let me just change the template here. I think Apple is going to go a little bit lower, maybe down to the 170. I think Amazon is finally going to give up the ghost and maybe go down to about 116. I think Meta is going to subside a little bit, maybe go down to the base of around 247 to start off with. And let's not forget NVIDIA. That's right, NVIDIA looks like it's going to start filling this gap as soon as it breaks the 365.70 level. And what was the other one that I was missing? I got Meta and NVIDIA. Oh, Google. How could I forget about old Google, right? And as you can see here, Google, they're all doing exactly the same thing. If I was to put all these charts next to each other, it would be equivalent of seeing this. So those stocks are just completely out of whack, and I believe they're going to be coming down. A lot of that is due to the AI frenzy that we're seeing right now. And Ken Griffith of Citadel Capital came out the other day and said, hey, it's way too much too fast. Way too much too fast. So keep an eye on these stocks, and also keep an eye on the Dow. Now, I'm going to go through individual sectors in a minute after I do the broad market review, but keep your eye on the Dow because I think the upside on the Dow is limited, and I'll show you some sectors that already appear to be breaking out, but they appear to be topping out, which is negative news. So there's a lot to talk about today. Lastly, before I get into the nitty-gritty, the bond market. One of the reasons the bond market, and I'll talk about this in a minute too, one of the reasons why the bond market is down is because Canada decided, as in a surprise move, to raise rates, which is putting pressure on U.S. bonds. I think the bond market is pretty close to bottoming out, at least in the short term, and I think we're going to see a bottom pattern here maybe in the next couple of days. But I'm actually expecting the bond market to rally and another sector to rally, and I'll talk about that in a minute. Now, let's talk about the nitty-gritty, and then I'll talk about sectors because today's Thursday, and on Thursday, I like to give you the best ETF and option pick. 3 major U.S. benchmark indices finished the regular session mixed as unexpected Bank of Canada, how dare they, increase forced investors to recalibrate their expectations regarding the Federal Reserve interest rate decision next week. And I told you that there is a chance the Fed is not going to be as bullish or bearish, that they're going to potentially say, hey, we got to take action here. And I'll get into that in a second too. In Wednesday, the tech-heavy Nasdaq underperformed major benchmark, posting its worst day since April 25th. Nobody here warned you about it, right? Nobody with the initials RS told you that the Nasdaq is not as strong as it appears, as Treasury yields climbed after the Bank of Canada unexpectedly raised interest rates. Campbell's Soup plunged over 8% and was the top percentage loser on the benchmark S&P. Can you imagine when Campbell's Soup is the top percentage laggard on the S&P? I mean, Campbell's Soup, we have a warning alert. Campbell's Soup is down on the day. It sounds funny. It really does. But they had some negative news, and that wasn't seen kindly to the consumer staple sector. But the fact of the matter is people need consumer staple, and they're going to be eating Campbell's soup no matter what happens with the economy. Energy stocks advanced. I'll talk about them extensively in a minute. And chip stocks also gained ground. But overall, the tech sector wasn't doing really great yesterday. Bank of Canada unexpectedly hiked its overnight benchmark by 0.25. Now they're at 4.75. The central bank said the concerns have increased the CPI inflation could get stuck materially above the 2% target. The odds of the U.S. raising or not raising rates on the 13th or 14th, which is just 5 days away. Now, there's a 32% chance of a 0.25 basis point rate hike. Now, this went up as high as 45%, and I think we're actually going to go higher, even though I don't think the Fed's going to do anything. I think that they're looking for any reason to discuss a possible increase next time. There's no way in hell they're pausing long term. This is just a wait and see to see what goes on and what's happening with what they've been doing. The Organization of Economic Cooperation and Development Wednesday slightly raised its 2023 global GDP forecast to 2.7 from previous estimates of 2.6, citing easing inflationary pressures and reopening of China. Today, all eyes are focused on the initial jobless claims data that's coming out in a couple of hours. Economists are expecting it to be around 235,000. Anything around 235, 240, 220, unless it's like 280, is going to be completely in line with expectations. China closed higher as optimism over more stimulus measures boosted sentiment, while market participants looked ahead to consumer and producer inflation data. Again, they're having a much harder time getting out of this COVID lockdown, supply chain, industrial production factor than U.S. did, because they were locked up twice as long as we have. And it's very hard to just spruce back up like nothing happened from that type of an economic contraction. At the same time, the Nikkei retreated further from a 33-year high as investors locked in profits, or as I like to say, took losses. For everybody who took a profit, the other half took a loss. Also, a tick up in the yen weighted on export-oriented stocks. Revised data on Thursday showed that the country's economy expanded more than initially expected in the first quarter. I told you their new head is going to be doing something. Their president or prime minister, he's a Harvard-trained economist, and he is going to start raising rates sooner than later. And I think that's one of the reasons why Warren Buffett is so gung-ho about Japan. Pre-market, GameStop, finally, they plunged instead of rallying 50%. That can tell you that we're not in a crazy bull market anymore, because 17% down is a lot more of what I expect versus what we saw last year. Huge runaway market. And today we're going to have earnings from DocuSign and Signet Jewelers. Now, as I mentioned earlier, I think the bond market's going to bottom out here, and I think tech is going to start going down, and a lot of flight to quality is going to come into the bond market and a few other sectors. Now, I want to warn you about something. This is the energy sector. Now, if you look at the chart of energy, and don't say I didn't warn you, because I'm warning you right now about this. If you look at the energy sector looks really bullish. Remember over here, we had really positive, they had not positive news, negative news for supply, which meant higher prices. And what did it do? It went down, and then it rallied afterwards. Now, it looks to be here breaking out above this little breakout. So if I was a betting man, just looking at this chart, I would say, hey, it's probably a good time to invest in energies. Wrong. Let me show you why. If you go to momentum levels on energies, look at where we're at right now. Look at where we're at. Do you think we're going to go much higher here? No. I think we're going to cool off from this level. So I'm expecting the energy sector to go back down. But again, if you look at it just technically, if you look at this chart, it looks like energy is about to go higher. In my opinion, in my humble opinion, that's not the case because of momentum levels. Now, if you look at momentum levels on other assets, which we'll look at right now, you will see energy 100%, financial 76%, industrial 95%. That's the other sector I was talking about. Look at industrial. It looks really good here. Really good, but look at momentum levels. See, it looks like it's breaking out, right? And it looks like it's going to go back up, just like the Dow. Matter of fact, industrial looks a lot like the Dow Jones. Let me show you something. Got to see this. This is industrial, and this is the Dow Jones. How different did they look? Industrial, Dow Jones. Tell me I'm crazy. They look almost identical. So if you look at industrial, industrial is right here, XLI. But if you look at industrial this way, here, if you look at industrial like this, you'll see that industrial stocks, 95th percentile. They're way, way too high up. It's all the way up here. Here, let me do this for you to make it easier for you to see everything. Look at that. How much higher do you think industrial is going to go? You don't think this is correlated to the Dow? Now, how about basic materials? 86. Do you think it's going to go much higher? So a lot of these sectors are getting overbought. Now, basic materials, maybe not as much, but again, industrial, look at that. Look at industrial, look at basic materials, look at energy. Here, let me. Real estate, materials, industrial, energy. You see what I'm talking about? Utilities looks like it's got some more to go. Consumer discretionary looks like it's on the downside. Healthcare looks like it's got more to go. And here's the gold mine, consumer staples. Consumer staples looks like it's just coming up right here. So you got to be really, really cautious right now, like really cautious. You're seeing this breakout in, and let's look at real estate too while we're at it. Let's look at real estate. Where's real estate? 97th percentile. Yep. So when we look at these sectors, and I really hope you review this video because this is eye-opening. Real estate, topping out. Basic materials, topping out. Utilities, not yet, a little bit more to go. Energy's topping out. Industrial, topping out. And that means the Dow Jones could be topping out really, 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 really soon. That's why I'm starting to get so short on so many different assets. So don't fall for the banana in the tailpipe. And when you look at all this, I love that saying. Jack Carter got me on that. Look at this, 100%, 95%, 97%. They're way overbought. So I'm looking at consumer discretionary and healthcare right now. Those are the only two sectors that are not grossly overbought right now. So be very, very, very careful. Most importantly, look at real estate. I mean, look at this. Most importantly, this can impact the Dow Jones negatively over the next couple of weeks. So be really, really cautious right now. Now, obviously, based on what I'm seeing, consumer staples has the best odds of continuing going higher. And that's why I'm recommending the consumer staple ETF. Although it doesn't look pretty right now, it doesn't look pretty at all. It's actually, the momentum levels are actually bottoming out on it. And it looks like it's going to be a good move. And same thing with healthcare. Now, it doesn't mean it's going to happen today. It could happen in a couple of weeks. You could still see a run-up in some of these. Like, for example, basic materials is not at 100 yet. Real estate's not at 100 yet. But some of these are going down. And like consumer discretionary, for example, look at the direction of the move. Look at where it's been going. This really hasn't been going up. Maybe a little bit in the last couple of days, but overall sentiment is going down. So there's a lot less stocks, and now you have overbought sectors, not just in the communication or the infotech, but now some of the blue chips are getting a little bit too overbought. So we want to look at XLP, and what we want to do is we want to go a little further on this. Want to go up to about 71 days. Give it about 3 weeks. If no movement, then get out of it. But I would give this a little extra time. This has 71 days to go. This way you're buying a little time and you can really wait for a good run-up move. It's like around $3. 71, 72 strike price, expiring 8/18, giving you the whole summer pretty much, January, February, March, April, all the way to August 18th. If you don't want to go out that far, you can go 43 days out, but don't hold this for more than 2.5 weeks. And in this case, you could save yourself about the 72. You could save yourself about 70% and buy this option for about $1.60, $1.50. So consumer staples is what I'm looking at, and maybe even healthcare. I think those are the sectors, and they're defensive too. And for that one, you'd want to go around the 130 strike price, 131. You could probably get each of them for about $1.50. Now, folks, be really cautious. Momentum levels don't lie. And before I let you go, the biggest discovery of my 3-decade career just triggered five under the radar stocks. I'm going live again today at 1 p.m. Eastern Time, Thursday, the 8th of June. Wow. And to give you these 5 stocks, all from my hottest algo trading strategy. And I'll also give you one last chance to claim my biggest gift of the year. The gift disappears at midnight tonight. That's right. It's the last time you could take advantage of this. Make sure to click the link below and check out the surprise I've got for you. It's a first anniversary for something big that I've done. And if you're watching on YouTube, make sure to like this channel, subscribe to our Telegram channel. You can go to rogerscott.com/Telegram and subscribe to our Telegram channel. Like, subscribe, and comment. Interact with me. I respond. Bye. Have a great day, folks. I'll see you later.